Okay, thank you for coming to the ReFinance Summit. This is the banking panel. We have some legends here on the stage, but I'm going to let them introduce themselves with all the hoopla that goes along with it. This panel is hosted by Isaac Filler. He's great. I have done some loans with him. His team is great. Michael, great job. Mazel tov. Oh, there you are, sorry. I was looking at your other guy. Isaac, take it away.
Okay, guys, so it's an honor and a pleasure to be here today. You have Andrew Walsh is getting all the softball questions today. He's closed a bunch of loans with us, so Andrew's going to have the privilege of having the easy questions today. Yona and I have conversed on many deals over the years. I haven't met Peter yet, but his reputation precedes him. And then you have Doug Romero, who probably has the most active balance sheet on construction in New York City. And I think that there's a great mix of lenders here. And I'm gonna ask each of the panelists to introduce themselves and to give you a little bit of their background more in depth. I'll then give some opening remarks, and then we'll go right into the questions, and hopefully it'll be an interesting panel, and you guys will enjoy. So, Doug, I'm gonna introduce you first, and please tell us a little bit about what you do, a little bit about how you do it, and what makes your bank a little bit different, you know?
Absolutely, Isaac, thank you. Good morning, everyone. Thank you for having me. Pleasure to speak in front of everybody. So my name is Douglas Romero. I'm Senior Vice President for Ponce Bank, headquartered in the Bronx. We're a local New York-based community bank, been around since 1960. I myself have been in banking for 23 years now. And I joined the bank in 2013. Around 2015, I became a member of the bank's senior credit team. I took the helm as essentially head of construction lending, senior vice president today, and we essentially grew the bank's book from a very nominal amount to right now we have outstanding about $1.5 billion in commitments, about $900 million in outstanding balances, and about 80 active construction loans throughout New York City, mainly New York City. Why New York City? Because number one, it's the greatest in our minds. And number two, because we really got in tune and we're very comfortable with the construction process that DOB allows. It's very transparent, it's very uniform. It's essentially follow the steps and you should have a completed building. You know, we don't necessarily see problems in construction. We just mainly run into people problems, personalities, things of that sort that would potentially obstruct the completion of a building. And as a lender, I mean, we're a lender that prides ourselves with that personal touch. So we're that type of institution that you can come in, meet with executive management, and we can sit down and hash out any particular nuances that need to be resolved.
So a true community bank.
True community bank. We're still that relationship lender, and it allows for us to maintain relatively agile when it comes to making credit decisions. That's very important. You're not just a number with us. We're not the bank that we need to reach out to an international conglomerate to get an answer. We'll give you an answer right then and there.
That's fantastic. And Peter, you work at a much larger institution. And if you could just, introduce yourself and some of the products that you guys focus on at KeyBank would be great.
Sure. Thank you very much for having me here
Thanks
tonight.
for coming.
I'm happy to be here. KeyBank is national bank. It's regional bank. We lend in all 50 states in terms of the real estate vertical that we have. Key is about $180, $190 billion in assets. I'm a senior vice president, senior banker with Key. Been there a little over 20 years, and we are a relationship bank. And and working with and understanding the client's needs and where things grow and move over time is what we seek to do. So on the balance sheet side, that's my day-to-day, and otherwise I'm a relationship managing the overall platform, because what we have is we have our floating over SOFR funds, which would be, for my group, Income Property Group, is going to be floating over SOFR, interim financing generally. We don't have a lot of 5 and 10-year paper on our books. We generally see things aiming between 1 and 3 years, going from point A to point B. It could be value add, it could be a quick close, it could be seasoning something that you've acquired that needs to then move on to the next phase, but it needs a home temporarily. Our cost of funds is probably pretty good. I think we're averaging 200 over SOFR, give or take 25 on either side of that or more. SOFR is 3.65 right now. Perhaps it will go down another 25, 50 basis points this year.
Now we're talking.
We use our balance sheet, and this group, the funds that we have, let's say it's about $8 billion, and 8, 9, $10 billion of that runs off about $3 billion a year. So we try and originate, at least in my group, about $3 billion a year. My clients are based in this region. We go anywhere in the country they go. The same platform, same rates, same everything. What we want to see is half that business convert to capital markets business. So Key has its own CMBS. We do billions in agency, Fannie, Freddie, HUD. We do life co-placement. We just are starting a debt fund. And we also are one of the largest servicers in the country. So the servicing our book is maybe $400 billion of stuff that we're servicing, and then $200 billion of special servicing. So that aggregation is something that makes it effective. So
So
again,
do you look at a lot of the ancillary products that you sell, the CMBS, the life insurance, the Fannie Mae? So your balance sheet loans are really to service and to end product those loans out with either CMBS, Fannie Mae, Freddie Mac, or whatever.
Ideally, yes, that's the perfect scenario where we're bringing something on and then it moves off at a certain point in time. But we'll fit whatever the client's needs, because that may not always be the case. They might be holding it for sale or any other things of that sort.
Right. It's not contingent on those exits, but it's
Right.
something that you guys look at as well.
Correct. That's that. And then we have a large Key public finance group where we can monetize to developers public benefits. If there's a public-private partnership, whether it be TIF or any bond financing, we underwrite and can create that.
Beautiful. Thank you for that overview. Yona Sternwind is a credit union, a Alliant Credit Union. He's not a bank. It functions as much as the same, looks like a duck, quacks like a duck, talks like a duck. But maybe you can give us a little bit about Alliant, Yona, and what you do.
Yeah, good morning, everyone. Thanks for having me here. And as Isaac said, I'm with Alliant Credit Union. We are somewhat similar to a bank, although a different construct. Credit unions in general are not-for-profit institutions. But the way Alliant works, though, we look to originate loans for the benefit of our members, because everything with a credit union comes back to how do you benefit and improve the lives of your members. So for us, we're looking to drive higher savings rates, lower home loan rates, car rates, all of that through our commercial real estate portfolio. As part of that, our lending platform acts different than most credit unions. Most credit unions tend to do things smaller loans than us, call it up to $4 or $5 million. We do larger loans. We're in the $10 to $30 million space. We tend to act a little more like a small life co than a traditional credit union in terms of how we lend and the types of properties we lend on. To give you a little bit of background on Alliant, we are the successor credit union to United Airlines Employee Credit Union. We're still heavily associated with them, but we broke off from them in the early 2000s. We're about a $20 billion credit union. We're the largest credit union in Illinois, the 7th or 8th largest credit union in the country. Our commercial portfolio today is around $2 billion. The average loan size that we do is about $15 million, give or take. We have a national platform. We go down to MSAs as small as about 150,000 people, so fairly granular in terms of where we lend to. And the focus of our platform really is flexibility. We offer minimal prepays. We don't have boxes to fit things into. We try to structure loans that meet the needs of the borrower. And that could be interest-only periods. It could be structured earnouts that look and feel kind of like an agency supplemental, but it is pre-approved and pre-documented day one, so borrowers know exactly what they're getting and what they have to do to get those additional funds down the line. We have flexible prepayment options, and really that's kind of the construct of our bank or of our credit union, our platform is being able to offer flexibility to our borrowers.
Yeah, I mean, that's something that really is different with a credit union than a bank. There's no prepayment penalty on a lot of your loans, or some of them?
Most credit unions do not have a prepayment penalty. We do. We're a state-chartered credit union, which
I did
is
not mean to call you out on that.
No, it's okay. I get that call probably 3 times a week saying, hey, you don't have any prepayment. I'm like, not exactly, but it's light. It's a 32100 and a 5-year loan, so it's a pretty light prepay.
Yeah, that's
regardless.
definitely the bottom of the barrel in terms of step-down penalties, so that's great.
We don't have any, but we waive it if they refi with us.
You know, I've been telling people that all the time, that they're going to waive it when you come back for the refi. It's just hard to get you to put that in writing sometimes. All right, guys, Peter's our new guy. Forget about everybody else. Andrew Walsh, the man needs no introduction to me, but I think he's someone that you guys should all meet. He has one of the most interesting balance sheets where he's willing to service the $1 to $15 million customer like the way people service the $10 to $50 million customer. And I don't know, Drew, take it away, baby.
Hi, Isaac, thank you for that. And it's awesome to be here, especially up on this stage with these other great lenders and institutions. I'm Andrew Walsh. I'm the Vice President of Commercial Lending at HAB Bank. We are a community bank, about $3.5 billion. We have a $2 billion portfolio of CRE. We're very active, and that $2 billion portfolio is 1,600 plus loans. So you can see we're doing smaller loans. Last year we closed 287 transactions. So we are hungry, we are active.
I'm not going to go out on a limb. I know that for a fact. That's the most loans done by probably any lender on the real estate side in New York, besides for JP Morgan, most likely, right?
Yeah, so we're very active, we're very hungry, we're looking to do deals. We're very asset focused. So my background is, which is why I love this particular conference, is I was an appraiser, and then I was a mortgage broker for 10 plus years, and now I'm a banker. So I've been on different sides of it.
Yeah, and definitely working with you, we feel that you understand the brokers, and you're speaking to a room full of brokers. So, you know, it's definitely helpful as you get into our psyche and our mindset. You know, and
it's advantageous to have been on the other side, and I'm looking forward to talking about that relationship between the broker and the lender. But once again, just super excited to be here.
Well, this thing's getting off to a fast start, but I did prepare some remarks to introduce myself, and then we'll jump right into the panel. So it's an honor and a pleasure to be here today and lead this important discussion with some of the most active lenders in the game. Special shout out to Walsh, who closed 6 transactions with our firm this year. So your interview will be more like a Joe Biden CNN interview. We'll give you the softballs. You know, a few weeks ago, they informed me that I'd be moving from panelist to moderator. Although I'm not really sure I should be moderating anything, you guys can speak to my wife for further confirmation. But it's a good thing that those who run the ReFinance Summit have yet to figure that out. I'm hoping this panel will be a little less volatile than the maturity defaults on New York City rent-stabilized properties, and hopefully we can all get along. For those who don't know me, my name is Isaac Filler. I am the managing partner of Filler Capital. Shout out to the whole crew who came out this morning. It's because of them that I'm here, but they'll literally go anywhere for free breakfast. So if there's breakfast, they will come. They don't have, you know, yes, they're on the payroll, but breakfast is good enough. To give you guys an idea, we've been behind the benchmark deals at 349 Fifth Avenue for $85 million. We just did a $78 million loan portfolio on the Lower East Side of 400 units. And we just raised the pref, the senior debt, and the mortgage on a prolific construction project in Coral Gables. The point of this discussion today is really to focus on what makes balance sheet lenders tick and what they specifically value from the sponsorship side as well as the deal metric side. As we emerge right now from the frozen markets of 23 and 24 to the great thaw of 25, where we saw a tremendous amount of private credit hitting the market, and CMBS lenders were as creative and active as ever. Now to the resurgence of our banks that are here today. It's a great time to understand what capital players who are keeping their loans on their balance sheet really think and desire in terms of loan products. For many brokers sitting here who have been doing this for, let's say, close to 2 decades, the first 15 years we couldn't miss. Every single deal was a cash out. Every deal was a rate reduction. And it's easy to be your client's best friend when you're selling 4% rates and $4 million cash outs, right? But the landscape over the last few years has been a little bit more difficult to navigate. Maturity defaults ran amok, rates skyrocketed, expenses continued to increase while rent growth remained flat. Now that the market has come back to its natural ebb and flow and we're seeing great competition even among the savings bank lenders, I think it's a great time to understand where these banks are, what they're doing, and what they're keeping on their balance sheet. So, first question that we have here. So, I'm going to ask Doug to lead this guy off, all right? Banks behaved very differently over the last 2 decades. than what brokers were used to. Some banks pulled back hard, other banks stayed active, but got very, very selective. From where you sit, what actually changes inside your institution when the market is going through something? And what do the brokers in this room who are still approaching deals like they did in 2020 and 2021 need to understand better about today's environment?
Thank you, Isaac.
Sure.
So to address those two questions, in terms of today's environment, capital is a lot more selective. Interest rates are higher, things are a little tighter. So there's a lot of reliance on, do we trust the sponsor? Do we trust the location? Do we trust the plan
rents.
the rents? Yeah, the plan of execution. Can we achieve?
The question is, Doug, is it easier to sell the dream than the reality on those rents, right? When we look at an occupied building, you know what the rents are, you're going to comp them, right? And every block is different, and every sub-market is different. And maybe you talk a little bit about how you get into that market and how you check those rents.
Yeah, you can't sell us the dream. And that's just the honest truth of it. I get all kinds of deal setups all day, every day. We're essentially deal junkies at the bank's corporate headquarters. We review deals all day. We run appraisals. We're engaged actively in loan approvals, credit committee meetings. And where our bank is particularly unique, we're essentially New Yorkers lending in New York, right? And I'm going to speak particularly to my catchment. You can't come to us in certain submarkets and tell us, hey, in Eastern Brooklyn, you're going to get $80 to $100 a rentable square foot. No, you're not. Absent a program, no, you're not.
How many months is that concession?
So things like that, that's what we would expect from the broker. We like and we prefer brokers who, number one, have experience, know the marketplace, and think like underwriters. Don't give me optimism, the glass is half full. Don't even give me, pessimism. Just let's be honest.
Just be a conduit for that information.
Correct.
In a clear fashion.
Correct. And these are the deals that get through. These are the partners that we select. And again, in a high interest rate environment, sponsorship matters, financial wherewithal matters, and trust. Can we trust the execution? Can we trust the plan?
It's funny you're talking about trust. We're refinancing a deal this week in my office, and the borrower doesn't have a C of O. And it's a big no-no for the lender, and it was a TCO that expired, and it was a problem. And it went back to credit committee, and the person on the credit committee had known this sponsor for 25 years, and he has stamped the deal for approval and closing. And I think what that story is that if you do what you say you're going to do, and you perform, and you draw the way you're supposed to, and you build the building the way you're supposed to, there's always a little bit of latitude from those lenders in moving their policies around if you do the right thing. And I think that's where the value comes in, where that relationship that we're talking about comes in, where you can see past that credit box because you understand the person behind it.
Correct. And that's where relationship kicks in and historical experience. So you may have a borrower that you're familiar with, that can deliver, but if we don't know them, if we have zero relationship, that's a very hard sell to establish and gain that latitude from the bank's credit committee. It's not so easy.
Yeah, so Andrew, let me ask you a question. So as things change, how did your balance sheet pressure, portfolio composition, the loans that you had that were made up, how does that decision-making change in a tighter market,
So we were in a unique position at HAB that we never really got into a lot of the stuff that got into trouble in the last few years, that larger office market, big rent stabilized.
Would you say that it's fair to say that you used the slowdown by a lot of the other banks in the industry to pick your spots today?
So we were able to, because of that balance sheet conservativeness, right? We were able to then gear up and pick up a lot of that slack over the last couple of years. So those balance sheet pressures that we didn't have, we still knew about them. We knew about them in other institutions, and we were able to use that to our advantage and learn some lessons from that to be able to then go after those asset classes at tighter underwriting.
Right, because if you're not walking into credit committee every day fighting on defaults and issues and problems, those deals, it becomes much harder in that room to approve deals. So if you weren't working out issues and you guys were conservative through the last cycle, it was more of a pedestal for you guys to move up in this cycle and step up at a great basis and get a much fatter interest rate for the longer term.
Correct, and we get to look like the hero to a lot of people. So it's
well, you're a hero to me. That's all that matters. Yona, if you could just talk a little bit about Alliant Credit Union's back leverage focus And because you guys are working in that back leverage space a little bit, you saw a lot of the lenders coming to you for A notes and B notes, and a lot of people don't even know this, but Alliant is one of the most active back leverage lenders on a lot of the construction loans that you'll see with S3 and other notable lenders in the in this space. And it's something that I didn't know about until recently, and I find it fascinating. And if you could talk a little bit about that back leverage, that would be an interesting scenario to talk about.
This is a program that we've had since about 2018. We've got about 15 lenders around the country where we focus on providing back leverage to them on an asset-specific basis for bridge, construction, generally transitional assets. In this program, the focus is really on who is our counterparty, who is the lender that we're focused on, but we do underwrite up and down the capital stack. So we kind of take a look and see who's the underlying sponsor, can they achieve the business plan, can the lender we're working with step in if there's ever an issue, do they understand the product that they're working on, and most of what we focus on is really understanding who that lender is. So for example, S3, like Isaac mentioned, we have a very strong relationship with them. They know New York real estate like the back of their hand. If they say, hey, we think the rents in this area are going to be X, Y, and Z rents, we trust that they know that because they've done billions of dollars of loans within a few very tight submarkets. So they really understand that platform.
So on those back leverage deals, the borrower is essentially the lending entity, not the sponsor who's the borrower to the actual fund, correct? And if you could talk about that a little bit and how that helps.
Yeah, correct. Our direct borrower is the lender. So in that example with S3, S3 is our borrower. But that being said, we still look up and down the capital stack because we want to make sure that their borrower, who is, for lack of a better term, the underlying borrower, the sponsor, that they've got the ability to achieve the business plan.
So there was a lot of optimism here on this, Peter. I don't want to make you the bad guy or anything, but I am curious that, I'm a young person, and I mentioned that for 15 years, every deal was a cash out and everything was easy, right? But you're still coming into a reset, and you're still coming into a new time, and there are still some things which I'm sure you're concerned about. And going into 2026, as you're starting to wrap up the first quarter and you're looking beyond, what are the holes that are still in the market in 2026, and what are the things that still concern you from the balance sheet side of things?
I think it all will tie back to the relationship. So things that are, there's stress in the market. And it's not fire sale stress I see, but it's just stress where if somebody bought a property, took a loan in 22, 21, 22, 23, and then rates jumped up, there's stress there. There was certain markets have had a lot of deliveries of construction, so property is going to take longer to lease up, more concessions, et cetera, stress there. So we try and find a way to work with clients and match their needs, but it's not so much exactly the deal that you're looking at today with this property right here. What are the other 4 properties that they have that have stress or don't have stress? So, is there anything that's really dragging away from their capability on performing on the loan that you're going to work on?
So it's not just the local MSA, but it may be the local city or the local town, and looking at the supply, looking at the demand, looking at the rents, see how they're trending, and making sure that you're underwriting to a number that you guys can be comfortable with overall.
Of course, and yes, it is different markets. While we're active in this market here, more than half of what I do is, I'm going to Tennessee in 2 weeks. I'll be in Austin later this month. Our sponsors, wherever they go, we follow. So you get the same relationship, the same people, and the same, hopefully, certainty of execution.
So there's the next question is really, there's been a shift that brokers often miss, right? And Yoni, you'll lead off with this, but banks are underwriting the sponsor just as much as they're underwriting the property today, right? Because the sponsor tells the story over a long period of time, and the property may have a shorter horizon, right? So what are you actually looking at today when you evaluate a borrower? And Yona, what does a weak sponsor profile do to an otherwise strong deal where all the metrics look great, but there's something going on in the background which doesn't work? And are there ways to navigate through that, or do you find that it's borrower 1 and deal 2, or is it deal 1 and borrower 2, and how do you reconcile some of those things?
For us, we've always been very sponsor heavy. We dig deep into the sponsors past. We look at their net worth, their liquidity, global coverage, everything about the sponsor. And the key for us is, do they have the experience to do what they say they're going to do? As I mentioned, can they execute the business plan for the underlying borrowers on the back leverage? For the traditional stabilized stuff, do they have the requisite experience to be able to own and operate these assets? And every once in a while you have a sponsor who may come in shifting from one asset class to another. Do we think that they can truly operate these properties? And I think that a weak borrower can significantly detract from an otherwise strong deal. To your question, is it deal first, sponsor first? It's really 1A, 1B. They're both important. We may have a deal that hits all the metrics, very strong, but with a sponsor who we think is a little iffy and may not have that experience, we'll probably back away from that deal because we're going to want to make sure that sponsor can own and operate and that they can achieve what they say they're going to achieve.
It's interesting. So I'm going to actually pose the question the opposite way to Peter. You're looking at a deal that's unbelievable, right? And the sponsor's not great. From your idea, if the deal is good enough, or let's just say the deal isn't great, but the sponsor is great, how does that come into your play, right? Because he's an A sponsor. The deal was a troubled deal. You know that already. Are you going to look at the fact that you guys have worked together before and you trust him, or is that not going to be enough,
No, I think the sponsor is going to carry the most weight. We're going to lean in wherever we can to work with folks that we've worked with before or to develop new relationships that look like they'll go forward. I think it's important to know the problems early. Like if something's wrong with the deal or some aspect's weak on it, fine. If the sponsor's great and it's very important to them, how can we get there? Maybe it wouldn't be your most highest leverage deal that you would typically do. Maybe you're 5 basis points up on the debt service coverage ratio. Maybe we're generally 20% of recourse, and I don't see a need to go much more than that ever, but how else can we make the deal slightly more conservative but still achieve their needs? Maybe it's a lower rate, but a little more structure.
Right, so if you're dealing with an entity or a person or a sponsor that you know intimately, you're willing to lean in for that person because they performed for you in the past.
You know how they've done in the past. And even if you haven't worked with that sponsor, you want to know how they, we use the word, acted when everybody's had multiple deals and have something that didn't go perfectly. So how did they behave?
Can I ask you a question? Maybe you could share an anecdote of a story where you were super impressed with a sponsor and there was an issue on a deal and the guy really performed, and how that helped him maybe go to the next deal with you guys. I mean, I don't know if there is, but...
Yeah, like I'm thinking of one where they delivered a retail, this is a couple years back, but it was a nice retail project. It was...
No one here will know if it was 7 years ago.
It was Amazon proof because it's experiential retail. So great, restaurants, everything, $20 million loan, opened 2 weeks before COVID. Not so many people attending, right? However,
it was more of a grand closing party than a grand opening party.
Yeah, but the net of it is a good sponsor. They're willing to. We just extended and worked with them, and there was a common goal, and you knew from what they had done and other things that these people are going to do the best they can. I can't expect them to make this happen, but there's time, and good sponsors will get more time, more anything we can do.
Doug, so I don't know if everyone here is familiar, but construction lending, and especially on Doug's side, is much more sponsor-focused, 100% probably sponsor-focused. How does experience and liquidity play into the decisions that you're making at the bank? And, just if you could share with us the way that things are progressing at the bank, and as you grow as an institution, how much does the liquidity and the experience mean to you guys,
So as we grow, experience and liquidity are obvious factors, for being able to lend and lend with confidence. At the same time, I don't want to discount the importance of market, submarket, location. That's also very important. I can have a strong sponsor who may want to go on another extreme and do program housing, and that just doesn't generally fit, our lending model or current philosophy, given the fact that we see all types of construction deal. Maybe we still want to stay where we're more comfortable in the regular, tax abated mixed income housing, that kind of thing. So a strong sponsor is always very important, but not the final determining factor for us. For us, it's more balance between location, planning, combined with a sponsor that's capable. Now, at the same time, we've had deals come up that are in fantastic submarkets, obvious corner lots. It's going to be a slam dunk construction. You can feel it. Our historical experience tells us this. But maybe the sponsor doesn't have that experience that one would want for a true middle market development. So how does that work out? Well, liquidity is always important. If they can show us and bring liquidity to the institution, checkbox number one. Checkbox number two is, okay, well, who's the team? Who are you putting together? Are you working with a contractor that we know? Are you working with a project manager that we know? Are you working with an architect that we know? Expediting consultants that we know. If you put the right team together, that could greatly mitigate some of the limited experience that a sponsor could have.
Yeah, so Peter, the next one's for you. So I think that it's a little bit of a touchy subject, but I would like to understand from your perspective how broker packages, information, how a deal is sent to you, and how that impacts pricing and what it looks like. And just generally speaking, when you're working with brokers, what do you like to see in a submission package, and how does that help you get through a credit committee,
Well, I'd say probably, I was a broker a number of years ago, but certainly understand how challenging and the importance of time, and that's what we all have is time. So if we're using it poorly, then we're really not going to achieve our goal. You can do everything perfectly and use the right time and still doesn't happen. We've been there. But
got to be buttoned up.
yeah, I need a couple things. I try and project to our clients that there's certainty of execution. And how do you get to that is to understand the deal, to get the right information from the get-go, to understand the good, the bad, the challenges. What three things have to be achieved? Is it, we got to move rents up, or we got to burn off concessions? What is it? And tell me. I mean, we'll figure it out also, but let's work together on it where it's a partnership. And working with brokers that we've worked with before or new ones that will work on other things, understand what the bank is, like what do we do best, and where's the strategic partnership come out of? I think that's time and certainty of execution is how we can head that way.
Yeah, and the only thing I'll say is that, dealing with complicated problems up front and giving your lender a heads up with clarity and understanding and say, it's a great deal, but there's nothing wrong with that, right? That's what people want to hear because it gives you a level of trust and believability which you don't otherwise have, right? Because if everything is rosy all the time, you're full of shit. So, it's very difficult to go around and just be that guy without having a normal conversation and saying 80% is good, 10% is bad. How do you want to handle it?
And I need that. I need to know because I have credibility within and with my credit team. And if this comes up in the middle of the deal, I'll give you a quote from my credit officer. Okay, this is the problem. This is solvable, but why didn't we know about it? What else don't we know? And I can't answer that. What don't we know? So let's get ahead of it.
Yeah, if I may, absolutely, Peter, to echo that, and I can't emphasize that more, the biggest deal killer is last-minute surprises. So please be upfront with any potential issues because more times than not, we can navigate through until we're getting ready for closing. And guess what? Judgments are popping up. Unpaid taxes are popping up. Guys, we wouldn't say anything. And that's actually reflective not only of ownership, but, the broker.
We talk about this a lot in our office, that every person that you speak to has a boss, has a superior, has a loan committee, has somebody else that is going to be participating in the information which you're sharing. And if the answer is there a lease expiration in 24 or 27, and you write yes, but you don't explain that there's 4 option periods and provide the subject lease and give them clarity and color, that guy's going to get executed at loan committee. He's not going to like you, and he's not going to do your deal, not because the information wasn't available, because you didn't take the time to put it together. And I think that's a lot of what you're saying. Andrew, let me ask you a question. So what specific information, can get your deal internally approved, and what are the gaps that you find the most lagging, in order to get something done?
So the information and how it's packaged is crucial, right? Because it's March 11th. I've underwritten over $1 billion worth of deals so far, and our average deal size is $1.5 million. So if it's discombobulated information that's coming in,
You're the fastest quoter in history. So I don't know.
if there's bad information coming in and it's not easy for me to process, I'm probably going to wait, do everything else first, and then get to that later. So the gaps can be just as simple as formatting, right? If you can get me something that's clear, I can see everything I need to see, I can get back to you quickly.
You're familiar with the packages we put together, right? So you know
Correct.
your debt yield, your NOI, your cash flow, your PFS, your underwriting, your rent rolls, your models, right? If everything is sitting there at your fingertips, if you can't read that in 5 minutes and tell me if you have a deal, I've done an awful job, right?
Exactly, and Filler Capital, 100%. I get those packages. There's a lot of other CBRE and Dansker, and I don't want to say everybody because I'm going to miss people, but there are, and Fortune, right? There are a lot of...
Shout out Jay Gluck.
Yeah. There are fantastic companies and brokers I deal with, and I'm pretty much 100% broker driven. But like I can echo everybody else here, if you're not upfront about the issues, right? Because every deal has problems, especially every deal I see is going to have something that's going on there. There's a reason it's coming to me. I can deal with it if I know about it. If I don't know about it, I can't deal with it, and credit committees hate surprises. So if it's well-presented information, I'll get back to you really quickly. If it's missing stuff and I lose that trust in you, right, it's not going to kill it. And I will take the time to work with new brokers and help them through the process, hold their hand on the first couple deals because they're going to grow as my bank grows, and I want, forever to be getting deals from them. But in terms of priority, when good formatted underwritings come in with the problems up front, I can get back to you very quickly and I can get approval very quickly.
So Yona, is there anything on the credit union side that is somewhat different than on the banking side when you look and you underwrite a deal that you like to focus on or that your institution values maybe more than a bank?
For us, especially on the direct stabilized stuff that we do, the stuff that's cash flowing, has been around for a little while, the most important thing that we don't get oftentimes from brokers right away are historicals. We tend to want to look back 2-3 years in history and see how has this property performed over time. More often than not, I'll get a package sent to me that has just an in-place pro forma, and they're like, hey, this property, it's crushing it right now. Great. How did it perform last year? How was it the year before? Because we want to see that longer time horizon to get an understanding for how the broader deal has performed and just what this property has been like over time.
All right, Andrew, you're up. One more. So brokers, we manage clients' timelines. That's what we do, and that's what they look to us for. But most of the actual people, they don't really understand what is happening inside your bank after the submission, right? They sign a term sheet, you smile and nod, everything is great. You start running credit, you start going through historicals, you start looking at tax returns, right? If you could just walk us through internally and tell us what slows down deals, what creates the biggest problems, and how do us, as brokers in this room, prevent those things from happening so we can get from point A to point B and make a fee, make our clients happy, and hopefully come back to you on the next one,
Right, so transparency from the bank side is, and I try to be as transparent as possible with the brokers I work with so they know where things are in the process, and from being a broker for so long, it's frustrating to get continually bombarded by your client of what's going on and you don't have anything to give them. So keeping the brokers apprised of where it is in the process is very important. It goes, where the hurdles are goes back to what we were just talking about. Surprises, right? Incomplete packages, bad information, because, I love and respect underwriters, but you do not want them thinking for themselves and trying to come up with answers, right?
You got to paint the picture if you want a good result,
Correct. You need to get ahead of everything that they're going to ask. You need to put it down clearly for them so that they don't have too many questions.
Right, that's why the broker is the most anxious guy in the room, because if you're not anticipating what your client wants from you or how the bank is going to want to look at it, and you haven't prepared him well, he could have used somebody else or he could have gone to the bank himself, right? So the idea is that we have the inside baseball from what you guys want, how you guys are looking at it, and hopefully we can take that to the next level.
Just
please,
to chime in, like the best brokers we work with are really basically their sponsors' CFO of sorts, right? Maybe that sponsor is not in the market. I mean, look, brokers know exactly what's going on, what the market, what's changing, what are the parameters that are important. And someone who's borrowing, once, twice a year, that's substantial. The market's moved every couple of months. You are that representative to them, to the market. And
I think what you're
especially-
saying is really interesting because
That's how we view it. Those who have the trust of their sponsors, they know it, and then they also know who to go to.
yeah, and also as a broker, your job is not just to forward the information, but to say, hey, there was a project next door that the rents were X. The performance of that project was Y. They just financed it at X, Y, and Z dollars per unit, right? So those conversations and brokers doing their homework is what's paramount in order for the process to happen.
Can I add to that
I would
too?
love to shut up,
So,
please.
so when you get a good package and you get a broker that gives you that information, it makes it a lot easier for you as the loan officer to go to bat for that broker, right? And there's trust that's built up over time doing multiple deals. So, and the rest of the bank knows about that, right? The credit committee knows where these deals are coming from. And if you mess up that trust, that's going to hurt you with separate customers that have nothing to do with that other deal, but it's going to also help your new customers that have never dealt with this bank before because they're dealing with someone who the bank has a lot of trust with, who has a relationship with. It gives me ammunition. Hey, it's coming from this guy. We've done a lot of deals with him. We know he's giving us good information.
I wanted to ask you, Peter, that at a large bank like Key, how does the broker keep the momentum going without overstepping and pissing everyone off, right? Those are the things that people are worried about because, yes, our job is to push, right? But our job is also to understand what your issues are, what you're working through internally, and to be able to keep the borrower on ice. So I was just curious, how do we keep away from overstepping and, sort of pushing you guys around?
Yeah, I mean, look, certainly have a discussion with the person you're working with, and the information up front is great. We do a lot of heavy underwriting on the front side before we do a term sheet. Once we do a term sheet, it's already gone to myself, my regional, and my credit officer. We don't have a committee, so it's really like 4 signatures. And as long as we have a constant relationship of proper information going forward, there's a long memory on those 4 people, right?
Nobody forgets.
Right, and don't forget that this was all crap later on. So
And I think that the first time we really saw that was in the last few years as loans went bad and the bank called you up and said, hey, your borrower's not sending in tax returns, he's not sending in financial statements, right? And a lot of times, brokers, they don't have the ability to produce that information. We may not have it, but we do have the ability to be an advocate for the lender even after we get paid, right? We have the ability to be an advocate to say, you didn't send in your 2025s, you didn't send in your 2024s, Andrew's a good friend, get it to Andrew, get it to Peter, get it to Yona, get it to Doug. And those phone calls are what matters, on the banking side.
And to make the sponsor understand, the sponsor understand that you agree to just provide a rent roll. You agree to do certain things. If you're not doing
in
that,
your loan
that's
docs.
really going to hurt you going forward.
Yeah, thank you, Isaac, for mentioning
Sure.
that. Covenant follow-up is a major thing. I've had instances where I've called, let's just say I've tried to reach out to the borrower to no avail. I've called the originating broker. I say, hey, listen, this borrower so-and-so, we're following up on some information. They don't provide, they're non-responsive. Why are you calling me? We closed the deal already. That is the quickest way to never
Get your
enough
phone number
bid.
blocked and Doug Romero's phone.
100%. So don't be that guy, that person.
So we're going to stay on topic here. Doug, I'm going to ask you to lead on this question. Every banker in this room has a short list of brokers that they actually want to hear from and a long list that they don't want to hear from. What do the brokers do over that time to earn your trust, Peter? And on the flip side, what are the behaviors that could just get you blacklisted?
It's a natural energy. I think brokers also have the task of being able to read the banker that they're working with, right? We all have individual personalities, and you have to know how to read the person.
You're saying a good mortgage broker is a good therapist.
Is almost. We spend more time on the phone than I do with the therapist, that's for sure.
100%. I don't think it might be a little cheaper.
I think so. No, the truth of it is some bankers have a higher stress tolerance than others. Like, for example, I consider myself one of those high stress tolerant people. Other bankers don't. So you can call me maybe 3-4 times a day. And even if I don't have anything in particular to respond back, I'll tell you, hey, listen, I don't have an update, but I expect to get one. Give me another day, give me Thursday, whatever. And you just continue that dialogue. other bankers just, oh, I'm in my lunch break, I can't answer this right now. Oh my God, they're calling me again. So you have to be able to read that person. And in terms of the brokers that we like to deal with, again, I'll go back to, you want someone who basically knows how to think like an underwriter, who's realistic and open about their expectations, projections. You know, learn how to gauge when a bank is saying, hey, listen, this is a little bit above our comfort zone. Don't try to sell us the same thing over and over and over and over, because that's another way to get blacklisted. It's like, guys, I keep trying to explain, you're not understanding. And
So shoving it down your throat is not a great way to get anything
not
done.
a great way.
Right.
no.
So if I ask you 11 times instead of 10,
That's, you know, a
you're gonna need
little
some
bit of
new-
deal breaker.
You're gonna need some new information on that.
Deal breaker, yeah.
Yona, from an originator's perspective, what habits, consistency, signals separate a broker who becomes a long-term partner for you, or just somebody who's like transactional and you'll do a deal for him?
I mean, I think a lot of it goes back to the things we've talked about, starting with a good submission package, you know, giving us the information up front so I can easily get through the deal, being a true partner, you know, coming back, I'll usually come back with a laundry list of questions. We dig pretty deep at the front end, because when I give a quote, I want to know that I can stand behind that quote, right? So being a good partner, working with me to answer those questions, you know, working with us throughout the process, that's going to develop a really good long-term relationship. Beyond closing, to the points we mentioned before, working with us for covenant compliance, for reaching out to borrowers, just being responsive, being there with us, providing that information, that's going to create a really good relationship going forward that then I can turn to my team and say, hey, this came from so-and-so broker, you know, you guys know them, I know them, we've closed X number of deals, we can trust this information. Versus if we get something that is just, you know, it's iffy, we can't trust the information, we don't necessarily trust the broker, we're just going to throw it out right away. So getting a good package day one, being responsive, and working with us throughout the process is really going to be the most important aspects.
So Andrew, what does trust look like inside that boardroom, right? And how does that broker become a known quantity in your credit committee? And does where the deal generate from carry a lot of weight within your committee?
So it does. It does carry a lot of weight because like I said, our bank is very broker driven. We have great relationships with the brokers we work with. I'm not going to say it's easy to get burned, right? If, you know, people make mistakes and we're forgiving in that sense, but trust is built up. I personally really appreciate high hit rates, meaning brokers that really know which banks are doing
Yeah,
what.
guys, this is a PSA. If a guy sends you an email with a term sheet with terms, and you ask him for a term sheet, and you don't sign up that term sheet, he's gone to credit committee, written a memo, spoke to 14 people, got 3 people to sign off on it, sent you a term sheet just so your guy can pontificate on it. Your job is to lay out that email, give the client those terms, get them on board, and then get that letter. Maybe you want to talk a little bit about that.
So 100% correct. A high hit rate, meaning it's really easy to stop quoting deals from a broker who sends a deal to 50 different lending institutions, and you maybe have a shot 1 out of every 100 term sheets you send out. I'm going to stop writing term sheets, right? So we really appreciate the brokers that go to that 2 or 3 or 4 banks that they know do that type of deal and have already done the work to understand who's going to be the best
Yeah, and
lender.
it's something that I say all the time. If your broker sends you a list of 60 lenders that he sent your deal to, he's just fishing. He's not actively advocating for you. He doesn't know where it's supposed to go, and he's shooting completely in the dark, right? When I get a submission on a certain block or in a certain place, I know there might be 10 lenders who will quote it. There'll be 5 that'll be the most aggressive, and within 25 minutes, I can speak to 3 out of those 5 guys and get that feedback back to you guys.
If I may, just a fair warning too, the lending space is very small, particularly in construction. Our term sheets get out, I'll get a call from another lender to, hey, I just got your term sheet. We're going to beat your rate. And I said, no, you're not. And, you know, it gets out. That automatically becomes a turnoff.
Yeah, I mean, you could just say it's a huge no-no, right?
Yeah.
If you send me a term sheet and I take your term sheet, I send it to another bank, and that guy calls you up and says, hey, I heard you're bidding on this also,
Yeah.
there's many times where that's going to blow up in your face, and there's a way to negotiate that deal, get the tactics done in a proper way, and have those conversations without forwarding everyone's proprietary information up the moon, you know?
If I can add also, I mean, knowing your banking institutions is key. Knowing the program, understanding what they do, like you said, blasting out the 60 people doesn't work, but also knowing what these guys are looking for. I can't tell you the number of times I've spoken to brokers saying, hey, we don't do any office, and the next day they call me up, hey, I've got the best office for you ever. It doesn't work, and it doesn't create a lot of trust between me and the brokers, because they don't know what I do then, clearly, and they're not listening to what we tell them.
Peter, go ahead. I know you were going to add.
I concur with you. I mean, that's know what's
You're
supposed
not
to be
getting
there.
off the hook so easy. You're going to close out the panel for us, Peter. For all the brokers here in the room today, maybe you can tell us what is the single most important thing that a broker can do starting tomorrow to change how they are perceived by a lender, and what they can do to be more likable and be more user-friendly, you know?
Good red Cabernet. No.
Send a great bottle of scotch.
Really, it's back to the same theme: time, certainty of execution. Take a moment and listen to the bank or entity you're discussing. Take the time to talk to your sponsor to understand what they truly want, instead of just, I get the cheapest rate. You know, what's the holistic view of the package, and help us be able to perform.
Yeah, and I'll just close by saying that a lot of times it is about a quarter of a point, a lot of times it is about a fee, but the people that you'll look and you'll do business with over your lifetime or over a long period of time are much more focused on the result. They're much more focused on the people, and they're much more focused on the user-friendly ability of that lender and that broker. Yes, sometimes you need that quarter point to win the deal, and hopefully your lending partner is understanding of that, and they'll push for you. But once you've done a deal with a lender and they like each other, your easiest path of resistance is sometimes to get the banker and the borrower on the phone and just say, guys, can you come together? I know the other bank's a little bit cheaper, but you guys really know each other. Maybe missing out on this opportunity, isn't the right deal. So I don't know if anyone has any follow-up on that, but
Or it could be something other than that quarter point. It could be,
a million things.
how else can we structure this differently?
Right, I'm
What do you
saying-
really need? Do you want IO the whole time? Maybe that, whatever.
Correct, right. So it's very, very important that I think in 2026, what I'll say is that the sponsors are no longer the Wizard of Oz, where they just stay behind this thing and the broker fires everything off or whatever. As banks are working through defaults and as they're working through interesting scenarios, they've come to the realization that having direct contact with that borrower is an important thing, but it's also a good thing for you as a broker. If you're not just insecure about protecting yourself from the borrower talking to the lender, and you're not secure enough in your position as a broker to make something happen, you're hurting your client and you're also hurting the banker. So that's what I got to say.
I mean, it's time, right? We can't work effectively without working with our time properly.
That's all for me. If anyone else has to close it out, or...